Hello, everyone, and welcome to Financial Accounting. Today, we continue studying financial assets. Our topic today is accounts receivable. We will learn how to account for uncollectible receivables using the allowance and direct write-off methods, and discuss how to present accounts receivable on the balance sheet. Finally, we will briefly discuss internal controls over accounts receivable. If you would like to learn more about financial assets, watch the video overview of financial assets. The link to the video is in the upper right corner, and I will also post it in the description to this video. Let's quickly review the rules of debit and credit and the accounts that we're going to use during this video. The accounting equation is assets equal liabilities plus owner's equity. Since assets are on the opposite side of the equation from liabilities and owner's equity, the rules are different. Assets are increased by debit and decreased by credit. Liabilities and owner's equity are increased by credit and decreased by debit. Cash and accounts receivable are asset accounts and are increased by debit and decreased by credit. Uncollectible accounts expense, also known as bad debt expense, is an expense account and is increased by debit and decreased by credit. The allowance for doubtful accounts is a contra-asset account. It is increased by credit and decreased by debit. And just a quick reminder, expenses decrease owner's equity and revenues increase owner's equity. It is often assumed that all of the accounts receivable will be collected. In reality, payments might not be received for some customer invoices. Businesses must account for the fact that some customers may not be able to pay their invoices. At the end of the period, a company should estimate how much of its accounts receivable will not be collected. This estimate is based on past collection history as well as on current economic information. Remember that when this estimate is made, it's not known which customer won't pay. If we knew which customer won't pay, we would never sell them on credit in the first place, right? Let's look at the general journal entry to record the estimate of uncollectible accounts. The entry requires a debit to uncollectible account expense and credit to allowance for doubtful accounts for the estimated amount. Why isn't accounts receivable credited in this entry? Remember, this recording is an estimate of uncollectible accounts, and it's not known specifically who will not pay. If accounts receivable was credited, which customer's account would be used? Because this is unknown, the allowance for doubtful accounts is credited. Uncollectible accounts expense, also known as bad debt expense, is classified as a selling expense on the income statement. Allowance for doubtful accounts is a contra-asset account and has a normal credit balance. It is reported on the balance sheet as a subtraction from the accounts receivable balance to arrive at the amount of accounts receivable that is likely to be collected. On the balance sheet, the allowance for doubtful accounts is subtracted from the accounts receivable balance. The reported value is called net realizable value and is the amount of accounts receivable that will likely be collected. And this is how it looks like on the balance sheet. Accounts receivable, 250,000, less allowance for doubtful accounts, 10,000. The total net realizable value of accounts receivable is 240,000. Now let's see what happens when it's been determined that a specific customer will not be able to pay the amount owed. When using the allowance method, write off an uncollectible account to allowance for doubtful accounts. The company debits allowance for doubtful accounts and credits accounts receivable. Now that the specific customer involved is known, the customer is noted in the transaction, so the proper entry in the accounts receivable ledger can be made. Now assume that before this write-off entry, the balance in accounts receivable was $10,000 and the balance in allowance for doubtful accounts was $2,500. Let's see what effect the write-off had on these accounts. After the $500 write-off, the accounts receivable balance is reduced to $9,500 and the allowance for doubtful accounts balance is reduced to $2,000. Notice that the $500 write-off did not change the net realizable value, nor did it affect any income statement accounts. At the end of each month, management should estimate the probable amount of uncollectible accounts and adjust the allowance for doubtful accounts to this new estimate. There are two methods to estimate uncollectible accounts. One method is the balance sheet approach, and the other is the income statement approach. Let's look at the balance sheet approach first. When using the balance sheet approach, first, classify the accounts receivable by age. Second, for each age group, determine the likelihood of being uncollectible. Third, for each age group, calculate a separate allowance amount. Finally, add up all the allowance amounts to get the balance in the allowance for doubtful accounts. First, ISTCO accounts receivable have been broken up into age categories such as current, 1 to 30 days past due, 31 to 60 days past due, and so on. Then, for each of these age groups, it was determined how much would be uncollectible. For the current age group, 1% is expected to be uncollectible. For the 1 to 30 days past due age group, 3% is expected to be uncollectible, and so on. Notice that the older the age group, the higher the uncollectible percentage. Next, the balance of each age group is multiplied by its uncollectible percentage. Then all of the uncollectible amounts are added up to $1,350, and this should be the balance in the allowance for doubtful accounts. Assume ISTCA already had a $500 balance in allowance for doubtful accounts. Since the balance should be $1,350, the account will need to be credited for $850. The entry would be to debit uncollectible account expense and credit allowance for doubtful accounts for $850. When using the income statement approach, the estimate at the end of the period is determined by taking current period sales and multiplying by an established bad debt percentage. The bad debt percentage is determined based on the past history of the company and current economic trends. The sales transactions included in this computation are typically only the credit sales. There are no any collection issues to consider for cash sales transactions. The credit loss estimate is calculated as net credit sales times the established uncollectible percentage. Assume ISTCA has yearly credit sales of $60,000. Management estimates that 1% of credit sales will eventually prove to be uncollectible. What is ISTCA company's adjusted entry for uncollectible accounts for this year? ISTCA would debit uncollectible accounts expense and credit allowance for doubtful accounts for $600, which is 1% of $60,000 in credit sales. Sometimes, after an account receivable has been written off, a customer will send in a payment. If this happens, should the customer payment be returned since the accounts receivable has been written off? Of course not. When this happens, two entries are necessary. The first entry is required to reverse the write-off and reestablish the accounts receivable. It includes a debit to accounts receivable and a credit to allowance for doubtful accounts. The second entry records the receipt of cash with a debit to cash and a credit to accounts receivable. Let's also look at the direct write-off method. When the direct write-off method is used, customers' accounts receivable are written off to uncollectible accounts expense. At the time, we learned that the customer will not be able to pay the amount owed. The uncollectible account expense is debited and the accounts receivable for a specific customer is credited. Note that we don't use the allowance account because we know which customer didn't pay. Under this method, we don't try to match revenues with the uncollectible accounts expense. Allowance methods provide much better matching of expenses in the period in which they help generate revenues. For this reason, generally accepted accounting principles require the use of allowance methods to estimate uncollectible accounts. The only exception is using the write-off method for immaterial amounts. Keep in mind that the direct write-off method is required when preparing tax returns. For a strong internal control environment, always try to separate the following duties: maintaining the accounts receivable subsidiary ledger, custody of cash receipts, and authorization of accounts receivable write-offs. Thank you for watching this video. Feel free to share it with anyone who might be also interested in learning accounting. In the next video, we will start reviewing inventory and the cost of goods sold. Don't forget to subscribe so you don't miss the next video. I will see you next week.